Finance Core, Topic 6, Capital Budgeting, Learning Objective number 3. We're going to evaluate a buy or lease decision and understand the importance of tax shields. So we're going to do a simple buy or lease. You're going to purchase a computer or you're going to lease a computer. Now this computer has no revenue impact, it's just a computer you need to run the business. Now the purchase cost would be $4,000 today. That must be a pretty nice computer, has no residual value, and will be fully depreciated straight line over 3 years. Depreciation will create a tax shield. We'll talk about that, which means a reduction in taxes equal to the depreciation times the tax rate. Now the operational lease will be 4 payments of $1,500 starting today and then 3 years from today. And all expenses create tax shields, so we'll have to consider the after-tax lease cost. So let's look at the model's inputs. I'm going to spend $4,000 today for purchase of a computer. I'm going to depreciate it 3 years using a straight line method and no residual. So let's think about the cash flows of the purchase. I spend $4,000 today. Now there's no other expenditures in the future. However, you're going to recognize 1/3 of that $4,000 every year because you're going to do a straight line depreciation. Now that is a non-cash expense depreciation. However, it's going to reduce your tax bill. So that depreciation expense is going to cause a reduction of taxes of $533 per year, even though there are no longer any operational expenditures. So one way of thinking about that is an operational cash flow is revenue minus OPEX minus depreciation after tax. So this is basically EBIT after tax, and add back depreciation. Now let's pull the depreciation out of this part of the equation. So that would be revenue minus OPEX after tax minus depreciation after tax plus depreciation. Remember, I'm adding depreciation because I'm trying to get to cash flow. Okay. Now let's distribute the depreciation through this. Depreciation minus depreciation times 1 and minus depreciation times minus the tax rate. So now we have revenue minus OPEX after tax. I have depreciation plus depreciation times tax plus depreciation. I'm sorry, minus depreciation. These cancel out. So my operational cash flows are revenue minus OPEX after tax plus depreciation times tax. Now, this plus depreciation times tax, we call that the depreciation tax yield. It's simply the reduction in taxes due to the fact that that the IRS recognizes depreciation as an actual expense. So I could do a real shortcut to my calculation of cash flows for the purchase. I spend $4,000 a year and no longer has revenue and expenses in the future years, operational expenditures. However, the fact that you depreciate 1/3 of $4,000 every year is going to save you $533 of taxes. So I'm assuming the company is already has positive profits, earnings before tax. So I'm going to assume that depreciation expense is going to reduce that amount of earnings before tax and save you $533 in taxes. Another assumption could be made: what if the company is actually not profitable? Well, there are certain things that companies are allowed to take losses from past years or profits from past years and get tax shields on those. So let's just assume the company is somehow able to recognize that tax savings. Let's go look down this equation a little bit more. Let's make it a little less messy here. All right. So again, operational free cash flow is my revenue minus OPEX after tax plus my depreciation tax shield. Let me just write this another way. Let's go from here. Let's just take the revenue and OPEX through the after taxes, and so it's after tax revenue minus after tax OPEX plus the depreciation tax shield. So what that allows me to do is then evaluate what if a project only has cost or only has revenue and has no cost of goods sold associated with this. So I'm going to use this little equation part here to talk about operating free cash flows for a lease. So these are my cash flows for the purchase. If I lease it, I'm going to spend $1,500 today, and then 1 year, 2 years, and 3 years from now. However, that $1,500, since I'm going to use this equation minus OPEX times 1 minus the tax rate is only going to cost me $900 a year after tax. So now I can evaluate these two columns to determine which is the better deal. Should I lease or purchase the equipment? So I'm going to go to my spreadsheet, go to purchase lease. There are my cash flows. I can spend $4,000 today. The only future cash flow, I'm going to take that $4,000, anchor it, divide it by 3 years depreciation. That's the $1,333 a year in depreciation expense, times my tax rate of 40%. And there's my 533. That's my depreciation tax yield. My lease cost me $1,500 a year. Anchor that times my 1 minus tax rate for my after-tax expense. And there it is. There's my NPV of purchase versus lease. Looks like the purchase has a lower NPV of cost, so I'm going to purchase and not lease. Now, there's a confusion a lot of people have. Why do I take depreciation expense times the tax rate, but I take my lease expense times 1 minus the tax rate? All right. Well, that's a good question if you had that, because depreciation is not a real expense. The only effect is the tax savings, which would be the depreciation expense times the tax rate. The lease expense, that's an actual cash expense. So I'm going to include the lease expense times 1 minus the tax rate. So the lease expense in effect does have a depreciation tax yield also equal to the depreciation times the tax rate, but it also has a cash expense of the lease. So I'm going to leave that in there. So I'm going to purchase this machine based on the current leasing rates and tax rates. On that topic, we just talked about depreciation tax yields and the decision to lease or buy a piece of equipment.